Harts, and it is a beautiful morning here over in Macclesfield. The sun is shining and the temperature is high. We're already up to 82 degrees here, and that's in old money. So what's that? That's about 28 degrees. So yeah, it's a warm one this morning, and hopefully you'll be all able to learn something and take away something from today's webinar. But first of all, we have to start with our usual disclaimer. So the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. First of all, I'm delighted to say that for those that didn't know, we won the Professional Services Firm of the Year for 2026 for the East Cheshire Chamber of Commerce, which is we're very proud of. It very much justifies the kind of level of service that we give our clients. Pass the word around. It's a great achievement, I think, to have done that. We have plenty of online resources for you, so follow us on LinkedIn. We are posting 5 times a week. So if you follow us, you'll catch up with all sorts of interesting information. We are on YouTube. We have our own YouTube channel. It has been going for quite some time, and we have over 6 years worth of content on there. So if you go to YouTube, search for Harts Limited, or even subscribe to us, you'll be able to catch up on anything that you may have missed. This seminar is being recorded and will appear on our YouTube channel later. So if you wanted to catch up on anything, please feel free to do so. And we are also on Spotify, where we have had some interviews with business owners who've seen it, done it, got the t-shirt and followed the same challenges and experienced the same challenges that you will have done in your businesses. So it's well worth hearing what they've got to say about it. Upcoming events, we have our Ladies in Business event from 12 till 2 on the 11th of June. If you want to get involved in that, please feel free to book on. Go to the Harts website and book on via the events page. And then on the 24th of June, we have our usual business club, Hollinhall Hotel, from 11:45 till 2. It's a great lunch where you can meet and network. We have some guest speakers. We put it on jointly with the North Cheshire Chamber of Commerce, along with Orbit Developments. So there's plenty of opportunity for some networking there. And a quick update. I'm going to jump to the last one on there because we had this announcement from Rachel Reeves. We have some great British summer savings. Yeah. So the mileage rate has increased to 55p a mile. This is one of those rates which was 45p a mile for the first 10,000 miles. And it's been like that for donkey's years. So she's decided finally to put that up by 10p a mile. So we're now on 55p a mile, and that's backdated to April. So it may be well worth checking your mileage records. You can claim an extra 10p a mile. Don't spend it all at once. And then we also have the VAT relief. Now then, they're cutting the cost of summer activities for families from the 25th of June to the 1st of September 2026. Where a reduced 5% VAT rate will apply to eligible services. Now, it's actually in the HMRC briefing notes, it actually says if the business chooses to pass the full benefit on, the total VAT will be saved for people going to some of these events or whatever. I don't imagine there's going to be huge amounts of businesses that are going to be passing it on, seeing all the people in the hospitality business will have been suffering over the last few years, but good luck to those that do, and hopefully many will do. So basically it covers children's meals served in restaurants for consumption on the premises, and children's and family tickets for cinema, theatre, exhibition shows and concerts, and admission tickets for both children and adults to such things as amusement parks, fairs, circuses, museums, zoos, adventure parks, soft play, and observation attractions. Interesting to see how this is going to operate and what they'll be doing to check up on it as well. So just bear in mind that. So if you're involved in any of those industries, then again, you will be looking to reduce your VAT rate, change your accounting systems. If you want any help on any of that, please get in touch. Making Tax Digital. That's in as from 6th of April this year. The first return, if you are affected by it, will be up to the 30th of June. and to be paid and to be submitted, rather, Freudian slip, to not until 7th of August. I say estimate of tax paid. I won't be actually collecting any tax, but we reckon that's what's going to happen in the future. And then bear in mind inheritance tax changes, where your pension pot, as from next April, will be part of your estate for inheritance tax purposes. So have a think about what you're going to do about that now, if there is anything to do regarding that, and take some advice. So please feel free again to get in touch with any of that. Okay, I'm going to stop sharing my screen now. I'm going to hand over to Alex Parks from Parks, and they're specialist mortgage and insurance brokers. Alex has had plenty of experience in this area, as well as he's a keen golfer as well, and actually plays golf with one of our team here. I've not asked who's won and who's lost, or whether there's any bets on who's going to win or lose, but I'll leave that. Supposedly, whatever happens on the golf course stays on the golf course. Is that right, Alex?
No, I won.
Oh, right. Okay, fair enough. So over to you.
Well, thanks very much, Steve. Really appreciate that. And yeah, just like to say, first of all, thank you very much to Harts Accountants for the opportunity to speak to you all. Steve mentioned mortgages are our specialist area. We work closely with business owners, directors, be they investors, first-time buyers, home movers, or remortgaging, because if you're self-employed, you could be at any stage, obviously, of the mortgage journey, or just looking to get one. So who are we? Well, hopefully my slide is working. It was a bit laggy earlier, wasn't it, Steve? Right, there we go. So yeah, so this is us. We're based in Congleton. I personally have 35 years plus experience in financial services. So worked in banks and building societies for the first 10 years of that, and then independent brokerages since then. We're a team of 4 now, so it's a bit of a generation game going on there. Hussein, that you can see in the background, is our other advisor. I'm the primary advisor. Hussein's the only reason that we have any social media whatsoever, because the 2 bald old boys sat on the city just don't have a clue with that sort of thing, really. And Caroline is our case manager, and she also specializes in buildings insurance, house insurance. So we currently do not charge broker fees, which is one of our biggest USPs. We're really trying to make our business work on referrals. So that's certainly something to bear in mind, because I do think it puts us in the sort of the minority of mortgage brokers. We've got 130 lenders to go at, whole of market. And one of the benefits, I suppose, about myself, even though we're a small business, this business has been going about 3 years. Before I started it, I did work, was a small shareholding director myself in a large new build brokerage doing 500 mortgages a month. So we had some very, very strong relationships with a lot of the lenders, which I've managed to retain despite our size. So it really does mean that I can get access to some people that really would never normally be able to get access to, and some, particularly with the smaller building society as well, can be very, very useful for self-employed circumstances. So as far as the agenda is concerned, don't pass out, please. I won't be talking for half an hour around each of these. So as I said, there's, self-employed people can be at various stages of their mortgage life. So I just wanted to touch on as many of them as I possibly could. The key thing really is about helping people understand perhaps a little bit about what's happening in the market, lenders' nuances, and really the value in the service that we can provide. Point 7 is a really interesting one. So I'll leave that hanging for a bit, because it just does demonstrate how stark the difference can be between, the different lenders and the way that they treat things. So as far as the market is concerned at the moment, I'm hesitating to say this after the conversation I've just had with Steve, to be honest, and apparently missiles flying again in the Middle East. But there's very rarely a dull moment in relation to, certainly, the economy and mortgage rates. I started in the early 90s when it was double-digit rates, and then we had 2008 financial crisis, 2020 COVID, 2022 Russia invading Ukraine. And then Trussonomics, which, to be honest, in recent times was probably the biggest thing that most people have experienced, because of how big the jump in interest rates was. And it was huge. People were coming off 1% interest rates and going up At one point, I think there was 7% they went to in such a short period of time. So that's just huge from a payment shock point of view. But thankfully, the latest thing really was obviously in April with the situation in Iran. I was talking to clients in January, February, when rates had started trundling down again, which was great, and probably hit, I think, on a typical 2-year fixed at a good loan to value, we were looking at about 3.6%, that sort of level. However, unfortunately, within a couple of months, I'm speaking to exactly the same clients, and then that interest rate was over 5. So that's just how quickly things can change. And, you know, because we're a global economy, aren't we? Let's face it. So that happened in a very short period of time. Thankfully, they have come down a little bit. I mean, at the moment, that 2-year fix is probably 4.6, maybe that sort of level. So they're still probably a good 1% higher than they were pre the situation in the Middle East, which you know, is just frustrating, and none of us could foresee really, but we just have to deal with what we have to deal with, because ultimately the rate is only half the story. A lot of it really is about what that equates to from a monthly payment point of view. So base rate wise, who knows? I mean, we have lenders coming in all the time. Their chief economist says X, but if you get 10 of them in the same room and ask them the same question, you'd probably get 11 different answers. We were hearing about 2 cuts this year at the beginning of the year. That turned into quite quickly 2 increases. It's gone a little bit quiet now. So we're just in a little period of stability as far as the interest rates is concerned, which is great from our point of view, because for 2 months it was a bit like mortgage whack-a-mole. And I'm not kidding in that we'd speak to somebody about a rate on a Monday. If they hadn't made the decision and got all their documents to us by the Tuesday, it was gone. And so with the 3 below it as well. So that thankfully seems to have settled down, and there is a little bit of stability there, which is good. As far as competition is concerned in the market, this is what's really good and is really helping with some of the movements in interest rates, because it is very, very competitive. The lenders, you know, as I said, there's 130 lenders we've got to go at plus, but we all know, I think 4 or 5 of them probably equate for the vast majority of the lending out there, and it is super competitive between them. They make a lot of money out of mortgages, and that's good from the point of view of creating you know, a decent interest rate environment. They really are making very little margin on them, but because of the volume they can get away with it. The other lenders though that sit outside of that know they can't compete on rate. So this is where the importance of advice comes in, I suppose, because my world's a bit like a funnel. We'll have 130 lenders at the top, and then conversations that we'll have with people will mean, well, those 10 won't do it, those 10 won't. And you end up at the bottom of the funnel with whichever lenders will consider, you know, a certain set of circumstances. And that's where, like I said, when you get away from just your general mainstream lenders, where the advice becomes really, really important. So moving on, what does that mean as far as self-employed are concerned, and what does that look like from a lending point of view? Well, typically, clearly, self-employed people will fall into various categories. These are the ones mainly that we see. I know that, you know, will be others outside of this, but yeah, your sole traders, limited company directors, your partnerships, and your contractors. Each of them have their own nuances and are treated, you know, differently by lenders in certain circumstances. So the track record is the first thing that I would sort of highlight, in that, what does that mean? Well, we often get asked how many years accounts do I need, you know, that sort of thing. So typically the answer to that normally is 2 to have your pick of the lenders, I suppose. There is still the odd one that asks for 3, but not many. But 2 really will open up the vast majority of the market to you. You can get away with 1, believe it or not. There are some lenders that will look at just 1 year's accounts, and one is on the high street, Halifax, actually. So they will look at 1 year. So it isn't a complete no-go, but as you can imagine, if you've got less than 2 years, that funnel gets narrow very, very quickly. There are other lenders with 1 year, but Halifax always tend to be the go-to from that point of view. So the more years, the better, in all honesty. Net profit is typically the income that will be used by the lenders from a sole trader point of view. They will normally average the last 2 years. Some will take the most recent year, which can be particularly handy and useful if it's the second year of trading, as you can imagine, because first year, a lot of costs. So lenders like Coventry Building Society, the Nottingham Building Society, again, some of the smaller societies are pretty good from that point of view, because that can make a big difference if they're just working on that higher individual latest year rather than averaging across the two. Salary and dividends is the way that most of the lenders, vast majority of the lenders in all honesty, will treat limited company directors. And again, the same principle will apply. They'll normally take the average of the last 2 years. And from a lending point of view, they're treated in much the same way as the net profit, from the fact that if the latest year is lower, they'll work on that, take the average of the two, and so on. But again, we do have access to lenders that will just take the most recent year on the salary and dividends as well. This is an interesting one because thankfully, I mean, the biggest change really for self-employed people, I think, with mortgages, which will spark a bit of a reaction for those that remember them or even know what they were, was when self-certified mortgages disappeared, which was in the ashes of the financial crisis in 2008. Now, it got a lot of bad press, really, self-certification, because it was seen as a license to lie, which unfortunately some of the American investment banks that were involved with those sorts of products, it probably was in a lot of cases. You could even get them for employed people. Why would you need to self-certify if you're employed? But they were really good in particular for using profits that you weren't actually drawing on because you perhaps didn't need to. So there are some lenders now that will allow us, and this has been around for a little while, but more and more lenders are becoming comfortable with it, will allow us to utilize profits that are retained depending on your shareholding, which often means that you can get an awful lot more on your affordability on your mortgage than you can by just relying on the salary and dividends. So that's, you know, an interesting slant, and thankfully a step in the right direction. So as far as actual different sectors are concerned, first-time buyers, this is where the Daily Mail love to have their field day, in that it's impossible to buy a house. You can't get on the property ladder. You need a massive deposit, 20% plus, huge income, perfect credit score. I mean, look, all those things clearly would be ideal and preferable. And don't get me wrong, in certain areas of the country, it is really hard for first-time buyers. However, to sort of burst some of those myths initially, and these, were relevant whether you're self-employed or not, but the deposit requirements, I mean, Halifax bought out a scheme last week where you could buy a £300,000 property as a first-time buyer with only a £5,000 deposit. So in real money, that's 1.6% basically. So that's pretty good. The rate obviously reflects that, but I'll always come back to the point that the rate really to a first-time buyer, I don't want to say is irrelevant, but it's just about what it equates to as a monthly payment. And that's where mortgage term and all that sort of stuff comes in. So there are some really good deposit schemes out there now. The Skipton Building Society, if you're a tenant, you've got a track record of renting, you can actually get a mortgage. It doesn't have to be the house you're currently living in that you buy as well. You can get a mortgage with no deposit at all. So zero deposit, effectively 100% loan to value. Schemes, family, I think the family is an interesting one from a deposit point of view, because I think there's something like the third or fourth biggest lender by money terms from a lending point of view. So we're still seeing an awful lot of those. The small deposit or the affordable housing schemes are really interesting because shared ownership has its place, where you can just buy a small proportion of the property and then your deposit is basically pitched against that. 25–50% are quite typical, because any step on the property ladder is a positive step, really. Low deposit schemes I've already mentioned. And the credit score myths, an interesting one, I suppose, because going back to the early 90s when I started in finance, there was a bank manager there that actually, made the decision, you bought, you sold to him. Now that could be good, could be bad, clearly. Now it's all credit scores, and it's very much Little Britain, you pass or you fail. You do not necessarily need a perfect score, though. And what is perfect? Because the irony with it is you have to have credit to create a good credit score. And a mortgage is one of the best pieces of credit you can have for your credit score, to be honest. But there are still lenders out there that have got very similar interest rates to the high street that don't use credit scoring. So even if there's a blip there, we can still potentially help. But clearly, the better, the better your credit score, the better chances you're going to have from getting the best rates out there, which is what everybody wants. So it doesn't have to be perfect, but yeah, clearly, the higher the better, I suppose.
Quick question, Alex.
Yes.
How do the lenders look at Bank of Mum and Dad? Because obviously a lot of the time they're going to be providing the deposit or contribute towards the deposit. Do they look on that favourably or unfavourably, or is there no difference?
It doesn't really matter, no, to be honest. They're more bothered about their risk, and their risk is effectively what the loan to value is. So if that's been improved by, a gift from family, then yeah, it doesn't really make any difference, to be honest, Steve.
Okay.
Yeah, with some lenders, they'll even accept gifts from friends if you've got a really generous friend. So it doesn't even have to be a direct family member, but typically, yeah, it's his parents.
Okay.
So yeah, moving on to remortgages then, once you bought your first house, because as I said, this is where really differences in interest rates over periods of time make a huge difference. Because as I've said, first time buyers don't really know any different. It's just what it is. So payment shocks, what are they? Well, I experienced one of these massively, coming off a 1.5% rate to I think nearly 5% within 6 months of starting the business, which wasn't much fun. £400-500 straight away on your mortgage payment. You don't get a big house for it. So this is one of the things that the government was very mindful of, particularly in, when Liz Truss did what she did, because that was the biggest real jump, I think, in interest rates in such a short period of time, from a percentage increase point of view, that we've sort of experienced, and the implications of that were pretty big, with people's affordability. So they introduced something called the Mortgage Charter, which is still in place at the moment, which means that no questions asked, people can extend the term, or they can go on to interest only for 6 months, things like that, which should always be taken with advice, clearly. But yeah, the term's the big thing. So you can get mortgages up to 40-year terms these days, and there's nothing wrong with that. You can even get a mortgage without too many questions asked, up to age 75, as long as it's part of a broader strategy. So nobody really wants a mortgage until that age, clearly, but we do that a lot for people who, for example, have got massive childcare costs at the moment, knowing fully well the strategy is to reduce it in the future. So it's all about getting the right advice at the right time. On the remortgage side, so your existing lender will always offer you a new deal as long as you've paid them, because funnily enough, they're not that bothered about keeping you if you haven't. We always encourage people, as you can imagine, to look at alternatives, because the lender you're with will probably only offer you a deal when you're within 3 to 4 months, whereas you can actually secure something in the wider market when you're up to 6 months out, which is what we're doing at the moment, particularly in a volatile market. Because if you've secured something 6 months out, it doesn't mean you have to stick with that. And we've got a mortgage monitor that basically will tell us if a better product becomes available between that point and completion. But at least it means you've got that locked in. So that's quite key at the moment. The one you lock in at that point isn't what you have to complete on, but it means it can't be taken off you. Okay, from that point of view. So I'd just say always get a second opinion. Your existing lender will make it very easy for you. Hit bish, bash, bash, a couple of buttons without taking any advice, which is best for them. It might not be best for you, though, because a lot of the time your existing lender doesn't have the best product available in the market. They rely on ease. So I just encourage you to get a second opinion. Or the worst you'll get is confirmation that they've got the best deal. Timing. I've already touched on this. 6 months out on a remortgage is what we're encouraging people at the moment, and we're contacting our clients in that regard, because the mortgage monitor's there really just to alert us if anything improves. Fixed or not to fix is the big debate really at the moment. 99% of the products that mortgages we were arranging were fixed rates prior to sort of April time. But what's happened in the market really since the Middle East, and this is how fixed rate mortgages are priced really, it's based on sentiment, what they think is going to happen, swap rates, bond markets, and those have all been pretty hammered really by what's going on. So what we found is fixed rate pricing has gone up on mortgages, but because Bank of England base rate hasn't gone up yet, the trackers actually now have gone from being more expensive really than the fixed rates from a direct interest rate comparison point of view to actually being priced relatively recently, you know, up to 0.75% lower. So all of a sudden it does make that conversation a lot harder. So there's no right or wrong unless you desperately want stability, in which case fixed is the only way to go. But there's a lot more people now considering tracker rates, which clearly track the Bank of England base rate, can go up, can go down, but the starting point of being lower than a fixed is quite appealing. So that's just something to consider. So as far as pitfalls are concerned with regards to, whoops, there you go. As far as actually approaching getting a mortgage, and if you're self-employed, things to certainly be aware of are reducing your profits too heavily. Let's face it, nobody likes paying tax, do they? So if you can reduce your profits in a tax efficient way, which I think is the right way of putting it, then yeah, great. That's great for your tax position, but it's not necessarily great when you're looking to achieve a mortgage. So again, it just sort of emphasizes the importance of speaking to your accountant and or an advisor like ourselves if you are thinking of moving, if your mortgage is coming up for renewal or something like that, because yeah, it could have implications of what you can and can't do, particularly if you're looking to move and you're locked in with a lender that won't look at things in, you know, a particularly favorable way. Delaying your personal tax return. So yeah, again, let alone paying tax, nobody likes paying it earlier either. So I would imagine the vast majority of people like myself probably pay it towards the end of January. However, there's a bit of a rule out there that a lot of people don't realize when it comes to mortgages, in that lenders really will only consider your personal tax return up to 18 months from the end of the previous financial year. So basically for tax year 24-25, you've got until October 26, October this year, and then effectively you've got to get it done quick, sharpish, or, you know, most lenders, there are some that will still lend, but not many, are basically locking off an awful lot of the market if you let it run beyond that, and then your mortgage happens to be up for renewal. So do just bear that in mind as well. Mixing personal and business spending, we do still see this a lot. With sole traders in particular, and particularly new sole traders. So just be wary of that, I suppose, because if it's difficult for a lender to differentiate between what is business and what is personal, it makes it difficult for them to sort of get a feel for your business and how it's performing, which particularly with sole traders and relatively newly formed sole traders is quite important. They do look at bank statements, a lot of them still. And changing business structure, this is, again, something that is quite relevant. I'm speaking to a lot of people who are going through the process of, most of the time, it's going sole trader to limited, which is fine. The only problem with that, as far as a mortgage is concerned, is you just need to bear in mind that a lot of lenders, and again, it's about this funnel for us, a lot of the lenders, a lot of them with the best rates, if you change your structure from self-employed from sole trader to limited, they will class that limited, even if it's the same people doing the same thing, no change there. They will basically start the clock ticking again with the trading period that they require. So that catches a lot of people out sometimes. So just bear that in mind. And again, particularly if you're thinking of moving, because if you're locked in on a mortgage and you want to port it, it's not a given. Porting means you can take your rate with you. It's not a given that you can actually take the mortgage, because you have to reapply again as if you're a new applicant. They will just apply the rate to that part of the mortgage if they approve you. So if all of a sudden you've changed your structure and they say, well, hang on a minute, you've only got 6 months as a limited company here, then you could cause yourself a problem and expose yourself to large early repayment charges if you need to move away from them. We are seeing a few property related issues. Leases there was a bit of a stigma attached to leases, really, and a lot of this was driven by the builders, the larger developers, who had some quite onerous lease terms in there with doubling ground rent in particular, and a lot of that's been unpicked now by the government and all new builds that are sold to freeholds. But unfortunately, it has created a bit of a stigma around leases. So and some lenders really are quite hot on and heavy with them with regards to the terms of the lease, what level of ground rent there is in relation to the value of the property. So that's just something to be mindful of. Leasehold, generally, the vast majority of them are absolutely fine. I live in a leasehold property, and a lot of the older properties, like a peppercorn lease, things like that, peppercorn ground rent, not an issue at all. So it tends to be on the newer properties within the last 20 years where there can be an issue there. Non-standard construction, unusual properties, again, that's something to be mindful of. You might see something that's really lovely property. We had one right next to a very nice pub. I would have liked to have gone to it myself and walked out my back door, but a lot of lenders are quite funny about that sort of things in where they will lend and how they will treat the actual security of the property itself, and also its construction. You know, might sound straightforward, but it's quite difficult to get mortgages sometimes on properties that are deemed to be non-standard. So that could be concrete, or it could be a beautiful thatched roof, you know, all those sorts of things. So just, again, be mindful. We are seeing some down valuations as well, not massively, more in the remortgage side, because people invariably, we try and push the valuation as much as we can, because it is down to opinion, to try and achieve a better loan to value for our clients. Sometimes they're particularly in a very buoyant market where you get these offers over. So if offers over 200,000, it might sell for 220, for example. But then a lender will go out and they'll say, well, hang on a minute, this was on for 200. Really, we probably think it's worth 210 max. So somebody could be willing to pay 220. But if the valuation comes in at 210, they will base all their lending against the 210, regardless of what price the client's paying. So that £10,000 difference there has to be funded from somewhere. So again, that's something we are seeing a little bit more of. And I suppose when interest rates start creeping up, that tends to happen. Unused credit facilities on the right hand side there. So what to watch out for. Again, this is just a bit of housekeeping, I suppose, from a credit rating point of view. If you're looking at particularly, you know, changing your mortgage or moving, having unused credit there, because look, we've all danced around, haven't we, 0% on credit cards. You just need to be aware, if you've got 60 grand's worth of credit card debt you could potentially get into, some lenders will say, well, you're going to use that as soon as you take our mortgage out. That's how, unfortunately, believe it or not, a lot of them will view it, and it will have an impact on your credit score. So just try and be mindful of that. And if you don't need them, just close them, basically, because once they're closed, then they become irrelevant. Buy now, pay later. Wow, you can even buy McDonald's, I think, on 3 monthly installments now. So Klarna is becoming a massive problem in our world with first-time buyers in particular. So just, again, be mindful. I saw somebody recently, 17 Klarnas. So yeah, it creates a bit of a problem in relation to credit scoring. They are generally only 3 months. So if you can pay for it, I mean, it just basically, a lender will look at it as being, well, if you can't afford to save for something like that and manage your finances accordingly, how are you going to pay a mortgage? Is sort of the attitude, and that gets factored into their credit scoring. So, you know, just to be mindful of those. Gambling, again, is one of the big sort of, not taboos, because it's all right to have the odd, you know, William Hill and so on. But if there's multiple gambling transactions on your bank statements, you just need to be mindful of that, because the lenders, again, it all gets factored into their algorithms. Undisclosed credit, stroke adverse credit, they'll find out. So we always encourage people, look, just be honest with us from that point of view. I'd always encourage people to register, because it's surprising how many people don't actually genuinely know they might have a default or a county court judgment against. Communications and utility bills are the worst, biggest culprits for this. They're complete and utter pain, because they'll put a default or a county court judgment on you, and a lot of the time it'll be because they can't find you after you've moved. As soon as look at you, and the effect on that for getting a mortgage can be pretty devastating, really. So yeah, honesty is always clearly the best policy, and the best way to be honest is if you know exactly what a lender is seeing, which is having a copy of your own credit file. There's 3 credit reference agencies out there: TransUnion, Experian, and Equifax. There's a company called Check My File, which is one I subscribe to. It's the only one that has all 3 on it, because some lenders, believe it or not, will use 1 or 2, and a few of them do use all 3. So yeah, just a few things there to look out for. They're relevant, really, whether you're self-employed or not self-employed, some of them. How to become mortgage ready? Well, you would think it goes without saying, but yeah, keep your accounts, tax returns up to date, know your numbers. But from that point of view, it's always good for us to have conversations and work hand in hand with you accountants like Harts in relation to positioning things if you are thinking of moving or needing to change your mortgage, because getting the numbers in the right way that they need to be can be important. Do you really need, for example, to make that pension lump sum contribution this year? Because a lot of lenders will take that out of the profit for mortgage purposes. The odd one that will allow us to drag it back in, but not many. So once it's gone, it's gone. So that can make a big difference. Unnecessary credit, I think I've touched on this really. That's like unused facilities that you're just not needing really. So if you don't need it, just get rid of it. Self-employed specific, I mean, and I mentioned about keeping your bank account clean there, sorry. So this is like gambling, things like that, and not running up, bang up to your overdraft limit every month. So that's just general, I suppose. That's what we mean by clean. Don't do money laundering for a few months. As you can probably imagine, it, the clue is there in sort of what I'm getting at. You've got to effectively make it so that it looks appealing from a lender's point of view when and if they do look at your bank account, because with open banking that's around at the moment, a lot of them will, with your permission, clearly be able to access, your bank account and see them even without physically having the bank statements. So all we would encourage you to do from a self-employed point of view is make sure, as I've already touched on, that you speak to your accountant, and we can speak to them as well, on your behalf, before actually finalising your accounts, because once they're done, they're done. And hopefully from what we've talked about, you've picked up that timing is key, really. So discussing your future mortgage plans, it might be that you're not thinking of moving for 18 months, but there's no harm in having a conversation. We speak to a lot of people well in advance of them actually moving. And, they told me to put this on, Stephen and Andrew at Harts. Keep your business accounts organised, because it's how you keep your accountant happy, isn't it? And it just means that from a timing point of view, when you come to look at a mortgage, and everybody's not having to scrabble around, it's just a lot easier if everything's, in the right place and so on. So I wanted to include a case study on here, which really is around one of the key parts of, a mortgage, which is the affordability side, and what a difference it can make depending on how your income is structured, really, and what a lender will potentially lend you. So it's just to highlight the affordability, and again, the importance really of speaking to someone such as yourselves. So I put on here just an example of self-employed company director for the purpose of this 100% shareholding. So clearly self-employed as far as the mortgage world is concerned, but employed for tax purposes. So this is what a lot of people sort of get confused over when they speak to me and say, but I'm an employee. Yeah, but you're an employee of your own company and you own 100% of it. So from a lender's point of view, you're self-employed. So I've already touched on that most lenders will use salary and dividends for their affordability. So in this situation, then you'd have your lender there looking at 20k dividends. So we'll say that was the case the last couple of years, and 12,570 on a salary. So we've got a system that thankfully that pumps into every lender's affordability calculator. So with a 32,570, you bit or below where they'll really start pushing the affordability multiples. So actually the max going to get on a mortgage really is around about 146k with that level of income. So you could, though, however, be the same person, but rather than using the salary and dividends, using share of profit. So because you're 100% shareholder, you're entitled to the 65k. You've not taken the 65k because you didn't need to. You just wanted the 32.5 to live because that's all you needed to live. So if we then all of a sudden look at a lender who will consider that, as you can probably imagine, you're then looking all of a sudden at a 77,570 income. And the difference is quite stark. So I think that opens most people's eyes, I suppose, because, it's huge. You're the same person, but it's just about how your income has been interpreted by the lenders. So, yeah, a massive difference And again, you know, everything doesn't theme here with what I'm saying really about emphasizing the importance of just speaking to somebody such as ourselves. So I did just want to touch as well on buy-to-lets, and it's be a bit like therapy for this for me, because I've got some, and I wish I hadn't a lot of the times, because I bought mine 20 plus years ago, saw them as a pension, not a megalomaniac. Property investor with 300 houses, which I think is how the government's, it feels like how the government sees to see every landlord anyway. But yeah, it's really difficult in the buy-to-let world at the moment. If you're an existing landlord and you don't have your properties in a limited company, which I do not, because the costs of putting them into it now are just a huge barrier. So effectively, you know, I've just got to like it or lump it really in that regard. So if you are thinking of starting out, that is one of the key decisions really on the buy-to-let, on the investment side, is whether to put it in a limited company or not. Now, we are not tax advisors. Clearly, this is where you'd speak to the likes of Harts, because we will be able to act on whatever advice you're given, because lenders will lend to limited companies. The products, the rates and everything, it's a lot more competitive these days, are very, very similar. So there are definitely options there. I can't say what's right or wrong clearly, because it will come down to individual circumstances. But there are certainly benefits from a mortgage point of view of putting it into a limited company, because unlike personal mortgages, a buy-to-let, really, how much you can borrow is driven by the amount of rent that the property is going to generate rather than your own personal income. So, and what they do is they tend to have a calculation that they use that is based on a certain interest rate, which will be a little bit above their normal mortgage pay rate. And then a multiple could be 125%, 145%, depending on whether you're a high rate taxpayer. But by it being in a limited company, those calculations are an awful lot more favourable. So your general rule is you will be able to get a bigger buy-to-let mortgage based on the rental if it's in a limited company than if it's in your personal name, because effectively the higher lower rate tax conversation doesn't come into it. It's all about corporation tax, about the business really. So the calculations they use are a lot more favourable. You're able to get bigger mortgages on that basis. Loan to value on buy-to-lets these days, you can get 80%, so 20% deposit really minimum, ideally 25%, because that's where you pretty much have access to virtually every buy-to-let lender out there, if you've got a 25% deposit. And yes, a lot more flexibility as well with buy-to-lets, whether it be interest only or capital repayment. They're not interested in what your repayment strategy is. Well, they are clearly. However, they're not as strict with it, because you don't have to carry on working in order to necessarily pay a buy-to-let mortgage. So the sale of property basically is accepted as the general rule with regards to interest-only mortgages and buy-to-lets. So it's a lot easier to get one of that. Just depends really on whether your strategy is about capital appreciation or whether it is about income. And again, that's down to yourselves. So I'm hoping that you found that useful, and there was a bit of information in there that you know, you're able to take away. From my point of view, it'd be good to ask if anybody has any specific questions.
Yeah, that sounds great, Alex. That was brilliant. Certainly, we are often asked the question, should it be limited company or sold in your own name for buy-to-lets? And it very much depends. We tend to suggest that if you've got them already in your own name, it is very difficult to stick them into a limited company.
I hope you were going to have a magic wand for me, Steve.
I'm afraid there isn't any magic wand, but it tends to be, if you want to build a buy-to-let portfolio, then start off as a limited company. But because there's so many restrictions now on the mortgages and so on, as a sole trader or doing it in your own name, that we have to do the calculation to see whether it's worthwhile or not. There's no fix-all. As you can see, we've got the QR code on there. If you want to get in touch with Alex at Parks, then feel free to do so. Has anybody got any questions? We have the chat box if you want to stick a question in the chat box. If you can't use your microphone, or you can just unmute yourself and ask a question. So if anybody's got any questions, please feel free to do so. We've got nothing coming through so far.
Oh, actually, I had a quick question, if you don't mind. If you can hear me okay. It was just on the sort of buy now, pay later bit that you touched on before, unused credit. Obviously, Amazon's a really good one at the moment for using those sort of facilities. And I was always led to believe that they're quite good to do in respect to credit scores, as long as you obviously pay them off. But you're more referring to if you've got a credit sort of limit that you're unused, is to sort of close those down.
Well, yeah, I think it's like anything. I suppose it's about it being reasonable, because I gave you one extreme of an example there, Andy, didn't I? Where and she literally had 16 of them. So that raises questions with a lender, if you think about it, about ability to actually manage finances and things. Now, you could argue actually it's a positive because she's spreading it and managing. So it's a really difficult one from that point of view. I think the odd one is absolutely fine. And yeah, if you're taking something out and paying it, that is great for credit score. I mean, I say to first-time buyers, because there's good credit and there's bad credit, I suppose. Having a credit card that you use for your fuel, food, and then pay it off each month is brilliant. Yeah. So that's great for a credit score. Having a gazillion Klarnas, good in some ways, but bad in others. The problem with credit scores is, it's a bit of a misnomer really, because people will see their Experian score. Well, that's a credit score. Lenders will use an application score, which has a lot of other stuff that goes into it as well, other than just a straight credit score. The unused credit facility really was more aimed at excessive credit cards, to be honest, where they could see that you could get into a load of debt the day after you take the mortgage out.
That's great.
I'm not sure if that's answered anything.
That's good. But no, I think it's reverting back to, it's interesting you saying that pre-planning, and we sort of see that quite often, that they come to us and say, I'm just sorting out a mortgage now. And quite often it's that, even a couple of years before gives us the opportunity to do a bit of strategy around where they want to be at a particular point in time in a couple of years' time when they do come to remortgage. So, and I know it's something me and Stephen do quite a lot of here. Well, we all do here at Harts. It's the conversations we have when we're looking at accounts. We're very much understanding personal circumstances and where that mortgage might fit in at the moment. So yeah, it's all about planning. And so
yeah, it is. And this is sometimes, isn't it, where like the pension contributions is a big one, 40 grand going into a pension. If you don't need it for mortgage affordability, absolutely fine. But yeah, a lot of lenders will just completely then disregard that. Whereas if it's still in your books, still in the business, we will have lenders that will consider it, clearly, because it's part of the profit.
Great, thank you very much. Anybody else got any questions they want to ask? I don't think we have any at the moment. I'm going to thank Alex for his very informative presentation this morning. I think that's been extremely useful. And I'm sure he'll stay online after we've finished this for a few minutes if anybody's got any questions and they don't want to be recorded. So just remains for me to say thank you very much indeed, Alex, for a very informative presentation.
Thank you.
We shall hopefully meet up soon. Thank you very much, and everybody else for joining us this morning, and I hope to see you soon on the next webinar.
Thanks a lot. Bye-bye.